So today let's talk about family trusts, how they are some of the most important vehicles or structures to grow wealth in Australia. So one of the DMs that I got after my last video was that people sometimes don't understand that they actually can run a business in a trust. So there are two different types of trust. One is a family trust, which is your discretionary trust, also known as a discretionary trust in more your accounting or legal terms. And discretionary trust, what it does is when it holds an asset, you can decide who the income is going to go to. So it's not a very strict kind of a structure. It's a very fluid and dynamic structure. What it helps people do is distribute income according to that specific income. So if that in one income year you've had a higher income and your partner's had a lower income, you can distribute income to your partner. And obviously you can't avoid distributing income because otherwise, according to section 100A, you are avoiding tax. So you don't do it in terms of avoiding tax, but you do it to maximize your ability to retain your profit. So that's, I think, a very key thing to know, that you can't just sort of avoid tax, but you just like maximize your ability legally to reduce your tax. So that's a family and discretionary trust, and most property investors, like people who are super wealthy, will hold their assets in a trust for that specific reason. That's the trust that they will use. Now, when it comes time to discussing a business structure or like an investment deal in a trust, that's where the unit trust comes into play. The unit trust is kind of like a company. So what it does is that in a unit trust, each person who becomes a unit holder, kind of in a company, each person who owns the company becomes a shareholder. So that's like probably the key difference between a unit trust and a discretionary trust. Discretionary trust kind of like is a wider net, let's just say that, because it's discretionary, whereas a unit trust is very strict in terms of then how you can distribute income based on the units of that trust. Now, why would somebody use a unit trust versus a discretionary trust, right? So the reason why someone may use a unit trust is when they've got investments, they've got a second party who is investing in their project and want to own the project or the asset in a trust. Now, trusts are probably one of the best, most tax efficient vehicles to own an asset in. And the reason for that is because once you distribute income from a sale of an asset, like sale of a property or sale of shares through a trust, you can pick and choose in a discretionary trust which person it's going to go to based on the deed of the trust. So you can't just pick someone on the street. They have to be written into the deed of the trust, and you have to make sure you don't contravene section 100A when doing that. Otherwise, if you purchase an asset in a company, for example, what the drawback of that is when you sell it, you don't get the CGT discount. Whereas in a trust, when you hold the asset, sell the asset, transfer the money to a person, you can get the CGT discount, because the CGT discount can only be applied to people effectively, not to companies. Which is why a lot of the times when people use bucket companies, they don't actually buy assets in the bucket company because they don't get the CGT discount. It's actually quite a large sum of money that you end up saving with the CGT discount, because CGT discount halves the total tax you have to pay when you sell an asset. And people bang on about CGT asset only being applicable to property. That's not the case. Any asset, for example, you own shares for longer than a year, you will get the CGT discount. If you owned like business shares, if you owned any other kind of asset like cryptocurrency, in a trust for longer than a year, you will also get the CGT discount, which is half tax on the money that you've made by selling the asset. That's pretty much it. I think I've answered the question that I got in my DM about the two different types of trusts, why sometimes people invest in a trust or have a business in a trust. But maybe with the business one, I'll do another one later on.